Right now, in this market, countless retail traders are turning themselves into liquidity for smart money, and most of them don't even realize it. If you don't understand this concept, you may stay trapped forever as liquidity for the big players. I was the same way, but eventually I realized something important. Trading is a zero-sum game, and if I want to survive in this market, I need to place my orders where smart money is placing theirs, and that place is usually exactly where your stop loss gets triggered. Today we're going to break down the liquidity principle that completely changed the way I trade, and it can change the way you trade as well. We'll look at it directly through the real Bitcoin chart. This concept is not difficult at all, so just watch comfortably and follow the logic step by step. Right now, I'm showing you the Bitcoin daily chart, and there is only one thing you need to focus on here: the clear swing highs and swing lows on the daily time frame. We are going to track Bitcoin from the 2021 daily chart all the way to the present. In January 2021, Bitcoin formed a major high, and from that high the market structure started developing like this. When a clear swing high forms like this, many traders expect that once price breaks above that high, a strong bullish trend should immediately continue. But what actually happened? As soon as price broke above the high, Bitcoin didn't immediately explode higher. Instead, it moved into a correction. And this is where the market goes against the classic chart knowledge that most retail traders have learned. Traditionally, a breakout above a major high is seen as a very strong bullish signal, but smart money uses that exact idea against retail traders. When a very obvious high forms on the chart, a huge amount of orders start building above that high. Traders who are bullish look at that high and think, if Bitcoin breaks above this level, a strong trend continuation will begin, so they enter long on the breakout. On the other side, traders who are shorting the market use that same major high as their invalidation level, so they place their stop losses right above it. And this is exactly why that area becomes so attractive. A lot of orders are concentrated there, a lot of liquidity is sitting there. And for smart money, who need large amounts of liquidity to fill large positions, this becomes a perfect execution zone. So the conclusion is simple. When a major daily swing high or swing low gets taken out, we look for the opposite trade. When price sweeps a major high, we are not looking to chase along. We are looking for a potential short. After that, Bitcoin moved lower and formed this swing low. Then the downside move started to slow down. Now we can mark this low as a potential area where we may look for a long setup if price breaks below it. And what happens next? Price sweeps that low, it takes the sell side liquidity below the low, and then it starts moving in the opposite direction. The same logic applies even when the trend continues. Here, Bitcoin forms another clear high and creates a visible supply area. Now, once price attempts to break above this high again, we can already understand what is likely happening. Price is reaching into the liquidity sitting above that high. It is taking the buy side liquidity. And after that, there is a strong possibility that price will rotate back into the range. So here, we are not looking for a long, we are looking for a short. The same thing happens in the next structure as well. After the decline slows down, another major swing high forms around this range. Price then sweeps the liquidity above that high, and from there, we look for a short setup again. After that, Bitcoin continues into another downside expansion. We can observe the same pattern again and again in the following ranges. Price breaks above a major high and then drops. Price breaks above a major high, grabs the liquidity, and then corrects. This repeats over and over. But in the next part of the structure, we finally start seeing the first sign that could reverse the trend. The strong decline that came before finally starts to slow down here. And as soon as Bitcoin sweeps this low, price immediately reacts upward. This candle structure shows a clear sweep of sell side liquidities. The liquidity sitting below this low was taken. And this is where we can start looking for a long setup. The same logic continues in the next structure. Bitcoin creates a clear high. It takes the liquidity above the high. Then it gives a downside expansion. At the same time, during that downside expansion, price also breaks below the low and sweeps the liquidity underneath it. After that, Bitcoin expands upward again. So the key idea is this. We always need to pay attention to major, then price sweeps that high. It takes the buy side liquidity. And after that liquidity sweep, Bitcoin gives a downside expansion. The same principle appears again in the next move. This decline eventually stops here. A major daily swing low becomes visible. And once that low is formed, price eventually sweeps it. It triggers the liquidity below the low. Then, after taking that liquidity, Bitcoin starts showing the real move in the opposite direction. The same thing happens in the next range as well. Bitcoin forms a clear structural low. Price sweeps that major low. It takes the sell side liquidity underneath it. And then the real expansion move begins. This is one of the core formulas of the chart. This next area is a range where Bitcoin moved sideways for more than 6 months. And inside this range, liquidity hunting happened again and again. Bitcoin sweeps a major daily low, it takes liquidity, then it expands. Again, Bitcoin sweeps another major daily low, it takes liquidity, then it expands. And the same pattern continues in the next phase of the chart. Even while price is moving upward, if Bitcoin sweeps a major high like this, we can still see a short-term downside expansion afterward. Price sweeps the major high, it takes buy-side liquidity, then it gives a downside expansion. Bitcoin keeps showing the same kind of movement repeatedly. In the next range, as soon as Bitcoin sweeps another major high, it takes the liquidity and then expands to the downside again. And before this upward move began, price also swept a major low first. It took the liquidity below the low, then it expanded upward. Even during corrections, the logic stays the same. Price sweeps a low and then moves up. Then price sweeps the next low again and moves up. This is the structure that keeps appearing on the Bitcoin chart. And the massive drop from last October, which pushed so many traders into fear, also happened based on the exact same principle. Before that decline, Bitcoin had already swept a high and then expanded lower. After that, Bitcoin formed another major high. It swept that high. It took the liquidity above it and then it expanded lower again. So what we need to do is very clear. We mark the major daily highs and lows in advance. And when those highs and lows get swept, we use those areas as possible reversal points. We trade in the opposite direction because those are the areas where the stop losses of countless retail traders are getting triggered. Let me summarize today's lesson very simply. Trading is a zero-sum game. We need to open positions in the areas where many traders are getting stopped out, and those areas are usually the clear swing highs and swing lows on the daily time frame. This concept is not difficult, it is not complicated, but if you actually apply this idea to your trading, I believe it can help you make much better decisions in the market. So I'll wrap up today's video here. Thank you for watching until the end.